In this video, you will learn what bear and bull markets are, their history, and the difference between them. What does bull market mean? In simple terms, a bull market is a period when the market experiences an increase in prices. So what does a bull market mean? In essence, this means that the buyers control the market and are the dominant players while the number of sellers is very small. The U.S. Securities and Exchange Commission defines a bull market as a time when stock prices are rising and market sentiment is bullish. Typically, a bull market occurs when the broad market stock index rises 20% or more for at least 2 months. Most investors prefer bull markets because most fund and pension portfolio managers only trade long positions. This means that they are limited to buying assets that will rise in value. And this is just one of the reasons why periods of bullishness in the market are really long. In fact, a bull market can form on any type of financial market instrument: stocks, indices, commodities, currencies, bonds, and so on. Having access to a range of tools can be useful for risk diversification in bull markets. Bull market and bear market, what is the difference between them? Bull markets are periods of time when the value and price of a financial asset rises. Bear markets are periods of time when the price of a financial asset falls and it depreciates. The U.S. Securities and Exchange Commission defines a bear market as a decline by 20% or more for at least 2 months. Basically, a bear market is the opposite of a bull market. Rising prices in a bull market inevitably leads to the fact that more investors come into the market who also want to capitalize on higher prices. This in turn improves market sentiment, thus attracting even more people and pushing prices up even more. In a bear market, the opposite is true. Falling prices cause pessimism in the market, which leads to a sharp and sustained decline in asset values. When prices fall, people tend to panic and make irrational decisions. This is the reason for the emergence of short-term positive sentiment in bear markets. The most famous bear markets were the 2000 dot-com bubble, the 2008 global financial crisis, and the 2020 coronavirus pandemic. Don't forget to subscribe to our channel and turn on notifications to stay updated. History of the bull market. Throughout history, we have seen many periods of bull markets, each of which lasted a different amount of time. Some bull markets are secular, meaning they can last anywhere from 5 to 25 years. The housing boom from 2002 to 2007, also known as the housing bubble, was a bull market. It arose after the U.S. Federal Reserve lowered interest rates to stimulate investment. In 2007, the stock market peaked, which marked the beginning of a recession and a bear market period. The record bull run lasted almost 11 years, with the S&P 500 stock market index rising over 400% during that period, and the rise in individual stocks was even more impressive. What's more, many analysts call it the biggest wealth-creating factor of our time, with nearly $20 trillion in returns in the stock market. The bull market ended in March 2020 during the coronavirus pandemic when the S&P 500 fell 33.9% between February 19, 2020 and March 23, 2020. After that, we saw a short bear market period that actually marked the beginning of the bull market from the March 2020 price lows. The index's all-time high on August 18, 2020 confirmed the start of a bull market cycle. How to understand that we are in a bull market? A bull market is similar to the boom phase of a business cycle. This is the most desirable time for investors as companies and businesses tend to make steady profits and the unemployment rate remains low. Since this situation allows consumers to spend and invest more funds, usually the stock market returns during this period. Let's look at the key characteristics of a bull market. The growth of the stock market is at least 20% in 2 or more months. As prices rise, investors' desire to keep buying only gets stronger, which only fuels the bull market. Drop in the unemployment rate. As positive market sentiment grows, companies begin to receive more funds from shareholders and usually expand their operations by hiring more people, which in turn reduces unemployment. Globally supported rally. Usually bull markets develop in conditions of loose monetary policy of central banks. For example, the longest bull market in history, from 2009 to March 2020, was fueled by record low interest rates. Traders and investors also commonly use technical analysis to identify bull market opportunities. For example, moving average technical indicators, which are widely used by traders and investors, help to find the long-term average of the price, as well as determine long-term trends. We hope that this video was useful for you. Please support our channel and write below what other topics you want to see.